Hi guys, this is Siajan and welcome back to my channel ACCA and beyond. I'm going to be continuing the revision series where I'm going to be revising each and every audit and assurance chapter with you guys for your exams. So, we had started with chapter 4 and I left it off over here. Yes. So, let's begin with self review threats for listed companies and internal audit services. So, for 1 second, sorry. Okay, so where non audit work is performed to an audit client and is then subject to audit, the auditor may not identify errors in their own work or may be unwilling to admit them. So basically, if you audit your own work, your objectivity is affected. Now, let's look at accounting and bookkeeping services. You're providing accounting and bookkeeping services to create an audit client can create a self review threat because the same work may later be audited. Accounting and bookkeeping services include preparing financial statements, determining accounting policies, passing journal entries, recording transactions, and payroll services. So these are core accounting functions. However, discussing accounting treatments and proposing adjustments uh, is a normal part of the audit and does not create a self review threat as long as the client makes the financial decisions. So auditors can suggest but not decide. For non-listed clients, a firm can only provide accounting and bookkeeping services that are routine or mechanical in nature. So only basic low-risk tasks are allowed. The work must be performed by individuals who are not part of the audit team, and an independent reviewer must review the work. Separation and review are important safeguards. Services that are routine and mechanical include payroll calculations based on client data, recording recurring transactions, calculating depreciation based on client inputs, posting entries to the ledger, and posting approved entries to the trial balance. So basically, tasks that require a little or no judgment. So overall, the key idea is to avoid auditing your own work unless the work is very basic and a proper safeguards are applied. Okay, so for listed clients, a firm cannot provide a listed or audit client with accounting and bookkeeping services. The rule is strict, these services are completely not allowed. For internal audit services, the firm must ensure that management takes full responsibility for internal audit services and internal control. The firm should never take over management roles. The firm should consider the materiality of financial statement amounts, the risk of misstatement, and the level of reliance placed on the internal audit work. So basically, how significant and risky the work is, and how much the audit client depends on it. For non-listed clients, internal audit services must be performed by professionals who are not part of the audit team. So again, separation of roles is important. And for listed clients, a firm cannot provide internal services if they relate to internal controls over financial reporting, financial systems, or material amounts in the financial statements. For listed clients, if the service affects financial areas, it is not allowed. So overall, the main idea is to avoid situations where the auditor ends up reviewing their own work. Should be avoided. Sorry. Now let's talk about tax services. Providing tax services to an audit client may create a self review and advocacy threat. The auditor might end up reviewing their own work or supporting the client's position, which should be avoided. Tax services include tax preparation, tax calculation, tax planning and advisory services, tax related valuations and assistance in tax disputes. So, these are the main types of tax services. The firm should consider the nature of the engagement, the client's level of tax expertise, and the complexity of the tax system. So, basically, how complex and risky the situation is. Now, let's look at tax return preparation. Preparing a tax return does not usually create a threat. Uh, it is based on historical information and is reviewed by authorities. So, this is generally considered low risk. For tax calculations, for non listed clients, the firm should use professionals who are not part of the audit team and an independent reviewer should review the work. So, again, separation and review are the key safeguards. For listed clients, the firm must not prepare tax calculations of current or deferred tax. Now, tax planning, so this is completely not allowed. For tax planning and advisory services, in addition to general factors, the firm should consider the level of subjectivity where the treatment is established and approved and whether the advice will have a material impact on the financial statements. So if the advice is subjective or significantly affects the financials, the risk become higher. So overall tax services can create multiple threats and the firm must carefully evaluate and apply safeguards to maintain independence. Okay, a firm should not provide tax planning and advisory services where the effectiveness of the advice depends on a particularly accounting treatment. If the advice relies on how something is accounted for, it creates a strong self review risk and is not allowed. When providing such services, the firm should use professionals who are not part of the audit team, have an independent reviewer, and obtain pre clearance from tax authorities. So, again, separation review and external validation are important safeguards. Now, let's look at assistance in the resolutions of tax disputes. The firm should consider management's role in disputes, the materiality of the outcome, whether the advice is part of the dispute, the legal support for the position, and whether the proceeds are public. Basically, how significant and sensitive the dispute is. For non listed clients, the firm must not act as an advocate before a tribunal or court if the amounts are involved are material to the financial statements. So, if the matter is significant, advocacy is not allowed. When services are provided, they must be performed by non audit team members and reviewed independently. Again, safeguards are applied. Now, for listed clients, the firm must not act as an advocate before a tribunal court or any tax dispute. For listed clients, the rule is stricter: no advocacy at all. The firm must still provide a continuing advisory role, such as responding to information requests or giving factual explanations. So, limited involvement is allowed, but not active representations. So, overall, in tax dispute, the firm must avoid taking a position that supports the client, especially in public or material matters. Now, let's talk about IT services. IT creates a self review thread and also result in assuming management responsibilities. So here the auditor might end up reviewing systems that help create or even taking over management's role. The firm should consider the nature of the service, how the IT system interact with financial statements, and the level of reliance placed on these systems. Basically, how important and impactful the system is. The firm can provide IT services such as design or implementation of services not related to financial reporting or implementation of standard software that does not require significant customization. So, low risk and non critical systems are allowed. For all clients, the work must be performed by professionals who are not part of the audit team. So, again, separation is important. The firm must ensure that management takes full responsibilities for IT systems and controls. The firm cannot take over management roles. For listed clients, a firm must not provide IT services that are a significant part of internal controls, or financial reporting, or that generate material information or financial statements. Sorry, yes. So, for listed clients, critical systems are off limits. Now, let's look at valuation services. Providing valuation services may create self review or advocacy threat. Yes. So again, the auditor might be reviewing their own work or supporting a position. The firm should consider the purpose of the evaluation and the client's involvement, the level of subjectivity, the materiality, and the dependence on future events. So if the valuation is subjective or has a high or big impact, the risk is higher. And my handwriting is very bad. So overall, both IT and valuation services must be carefully evaluated to avoid threat to independence. Some valuation services may not involve significant subjectivity, for example, where assumptions are set by law or standard techniques are widely accepted. So, in such cases, the risk is lower because there is less judgment involved. For non listed clients, valuation services may not be provided if they involve significant subjectivity and have a material effect on the financial statements. If both subjectivity and materiality are high, the service is not allowed. For listed clients, valuation services should not be provided if they create a self review threat. So for listed clients, the restriction is stricter. For all audit clients, the evaluation services are allowed. They must be performed by professionals who are not part of the audit team and reviewed by an independent reviewer. So again, separation and review acts as safeguards. Now let's talk about corporate finance services. Self review and advocacy threats may arise when the firm assists in strategies, acquisitions, disposal, raising finance, or structuring advice. So, here, the firm may become too involved in the client's decisions. The factors to consider include the level of subjectivity, whether the outcome is material, and whether the advice depends on a specific accounting treatment. So, the more the judgment and impact involved, the higher the risk. For prohibited services, corporate financing services that involve promoting or dealing in or underwriting the client's shares are not allowed. So the firm cannot directly support or promote the client's financial interest. So overall, valuation and corporate finance services must be carefully controlled and should be avoided for self-review and advocacy threats. Okay, yes. So the corporate finance services must not be provided where the effectiveness of the advice depends on a particular accounting treatment and the audit team has doubts about that treatment. So basically, if the success of the advice depends on how something is shown in the financial statements and the auditor is not confident about that treatment, it creates a serious self-review and bias issue. Because in that case, the auditor might feel pressured to agree with that accounting treatment just to support their own advice. Where such services are allowed, they must be performed by professionals who are not part of the audit team and reviewed by an independent reviewer. So, the idea here is to separate roles and ensure that someone independent checks the work. For listed clients, corporate finance services must not be provided if they create a self review threat. So, for listed companies, the rules are stricter because the impact on public interest is higher. Now, let's move to legal services. Providing legal services may create self review and advocacy threats. Uh, yes. So, again, the firm may end up reviewing its own work or supporting the client's position in a biased way. Sure. Legal services may only be provided by individuals who are legally qualified or authorized. Uh, so only experts are allowed to handle such work. The firm should consider the materiality of the matter and the complexity of the legal issue. So if the issue is significant or involves a lot of judgment, the risk increases. Where services are provided, they must be performed by non-audit team members and reviewed by an independent reviewer. So once again, separation and review acts as safeguards. As a partner, or employer must not act as a general counsel for an audit client. So the firm cannot take on a continuous legal advisory role, as that would clearly impair independence. A firm must not act as an advocate for an audit client when the amounts involved are material to the financial statements. So, if the matter is significant, the firm cannot represent or defend the client's position because at that point the auditor is no longer independent. They are supporting the client. So, overall, the corporate finance and legal services, the key focus is to avoid situations where the firm becomes too involved in decision making or starts supporting their clients. Now, let's look at temporary personal assignments. The loan or personal to client may create a self review, advocacy, and familiarity threat. So basically, when staff from the audit firm work temporarily with the client, they may later end up reviewing their own work, becoming too close to the client or even supporting the client's position. Staff may be loaned to the client only if the loan period is short. The individual does not take on management responsibilities and the client is responsible for supervision. So the key idea is that the person is only assisting, not making decisions. Where personnel is are loaned to the client include additional review of their work, not including them in the audit team and not assigning them audit responsibilities for area they have worked on. This ensures they are not auditing their own work and independence is maintained. Now let's look at serving as a director or officer. If member of our audit team serves as a director or officer of the client, it creates a self-review or self-interest because they are directly involved in managing the company. A partner or employee must not serve as a director of officer of an audit client. So this is completely prohibited. A partner or employee must also not act as a company secretary unless allowed by law. Management takes all decisions and the role is purely routine and administrative. So only very limited involvement is allowed in this case. Now let's look at situations where client staff joins the audit firm. Threats may arise if an audit team member has recently worked as a director or employee of the audit client. So here the person may still be influenced by their previous role or decisions. If the service was before the audit period, the significance depends on the position held, the time since leaving, and the role of the audit team. So we assess how recent and how significant their previous involvement was. So overall, these situations are carefully controlled to ensure that past or temporary relationships do not affect independence. So the audit team must not include individuals who, during the period covered by the auditor's report, served as a director or employee of the audit client. So if someone was part of the client's management during that period, they cannot be the part of the audit team at all. If the service before the audit period uh, if the service was before the audit period, an appropriate reviewer should review the work performed by that individual. So in that case, the risk is lower, uh, but still require an independent check. Now let's look at an example. If a partner of the audit firm is asked to sit on the audit committee, it creates a self-review and self-interest threat. This is because the audit committee is responsible for overseeing the auditor, deciding the fees, and recommending the auditor. So the auditor should basically be involved in reviewing their own work and decisions, which clearly affects independence. Now let's move to advocacy threats. Advocacy threats arise when the audit firm promotes the client's position or represents them, effectively taking the client's side. So here the auditor is no longer neutral, they are supporting the client. Examples include representing the client in court, negotiating finance on their behalf, loaning staff, and providing valuation of tax services. So whenever the firm is actively supporting or promoting the client, an advocacy threat exists. Now let's look at intimidation threats. Intimidation threats arise when the auditor faces actual or perceived pressure from the client. So this could affect the auditor's ability to act objectively. Examples include fee dependency, gifts and hospitality, family and personal relationships, recruitment services, employment with an audit client, and litigation between the audit firm and client. So basically, any situation where the auditor feels pressure or influence can create an intimidation threat. So overall, all these threats, self-interest, self-review, familiarity, advocacy, and intimidation, must be carefully identified and managed using appropriate safeguards to maintain independence. Now, let's talk about confidentiality. External auditors have a legal right to access to or to all information of their clients. So the auditors can access very sensitive and important business information. The client must not be able to trust that information that will not be disclosed to third parties as it could harm the business. So confidentiality is essential to maintain trust between the client and the auditor. Confidential information may come from the firm business relationships like current or past clients, and even prospective clients or employers. This responsibility applies in all professional situations, not just current engagements. Members of the assurance team must not disclose information outside the engagement team, even if the person works in the same firm. Now let's look at when disclosure is allowed. Confidential information should only be disclosed with proper authority or when there is a legal duty or professional duty. So, disclosure is the exception, not the rule. First, when disclosure is required by law. This includes providing documents and legal proceedings or reporting legal violations to authorities. So, in such cases, the auditor has no choice. Second, when disclosure is permitted and authorized. This is when the client or employer gives permission. So, with proper approval, disclosure is allowed. Third, when there is a professional duty. This includes complying with quality reviews, responding to regulatory investigations, protecting professional interest, and following ethical standards. So, here, disclosure is necessary to meet professional obligations. Now, before disclosing any information, the auditor should consider whether harm may be caused, whether the information is accurate and complete, and whether it is being shared with the right person. So careful judgment is required before any disclosure is made. So overall, confidentiality is about protecting sensitive information while allowing disclosure only in specific and justified situations. Now, let's look at specific examples of disclosure of confidential information, permitted or required by law. Where there is a legal duty, the professional accountant must disclose information without taking permission from the client. So, in these cases, the law overrides confidentiality. The most common offenses include fraud or theft, tax evasion, money laundering, drug trafficking, or terrorism, insider dealing, bribery, and offenses under company law. So basically, if any legal activity is identified, the auditor may be required to report it. Now let's look at disclosure in the public interest. An auditor may disclose information if they believe it in the public interest, although there is no strict definition of public interest. So this depends heavily on professional judgment. A good rule of thumb is that if the public could suffer financial or physical harm that the auditor could have prevented, then disclosure may be necessary. So the focus is on protecting people. Now, when deciding whether to disclose, the auditor should consider the size of and the amounts involved, the extent of potential damage, whether the public would be affected, and the likelihood of the issue happening again. So basically, how serious and widespread the impact is. The auditor should also consider why the client is unwilling to disclose the unseriousness of the matter, relevant laws and standards, and any legal advice obtained. So, a well informed and balanced decision is required. Finally, the auditor is protected from liability if the disclosure is made in the public interest to the appropriate authority and without any malicious intent. So, as long as the intention is right and the process is followed, the auditor is legally protected. Overall, confidentiality is important, but in cases involving law or public interest, disclosure becomes necessary and justified. Now, let's understand conflicts of interest. A conflict of interest arises when the same audit firm is involved with two clients that interact with each other. So basically, the firm is working two parties whose interest may clash. Like basically, they are from the same industries. Example include companies competing in the same market, trading with each other, involved in a legal dispute, or whether the firm advises both buyer and seller in the same transaction. Uh, a conflict of interest creates threat to objectivity and confidentiality. Because the firm may not be able to uh, act independently or keep information properly separated, it may be perceived that the auditor cannot provide objective advice if it is also auditing a competitor. It may so even perception matters, not just actual bias. Professional accountants must always act in the best interest of the client, but when multiple clients are involved, this becomes challenging. In such cases, the firm must organize its work to ensure that one client's interests are not negatively affected by another. Um, the firm must manage the situation carefully. The firm must disclose the conflict of interest to all relevant parties and obtain their consent to continue. So transparency is very important here. Now let's look at some safeguards. The firm should use separate engagement teams with different partners and clear confidentiality guidance. Key judgment and conclusion should be reviewed by an independent person. So, an extra level of objectivity is added to reduce the risk of information leakage. The firm should limit access to files, physically separate information use, confidentiality agreements, and provide proper training. So, both physical and procedural controls are used. Finally, if adequate safeguards cannot be applied or if consent is not given, the firm must decline or discontinue the engagement. So, if independence cannot be maintained, the firm should not continue. So, overall, conflict of interest must be carefully managed through disclosure, consent, and strong safeguards to maintain professional ethics. Now, let's look at accepting or continuing an audit engagement. An audit firm should only accept clients and work that are of appropriate level of risk. So, before taking on any client, the firm needs to assess whether the engagement is safe and suitable. This process is known as client screening. So the firm evaluates the client before accepting the engagement. Now, one of the key steps is professional clearance. If offered an audit role, the prospective auditor may ask the client for a permission to contact the existing auditor and refuse the engagement if permission is not granted. So the client does not allow communication. It is a red flag. The prospective auditor should then contact the outgoing auditor to obtain all relevant information, such as overdue fees, disagreements with management, or legal or ethical issues. So this helps identify any risk before accepting the client. If no reply is received, the auditor should attempt to contact the outgoing auditor through other means, such as telephone. If there is still no response, the auditor may accept the engagement but should proceed with caution. So, acceptance is possible, but risk awareness is important. If a reply is received, the auditor must carefully consider the response to identify any ethical or professional reasons to not accept the judgment. So, the final decision depends on the information received. The existing auditor must obtain permission from the client before responding to the prospective auditor. Confidentiality is maintained even in this process. If the client refuses permission, the existing auditor cannot provide the information, and this itself becomes a warning sign for the new auditor. Uh, Now let's look at other factors to consider before accepting an audit engagement. So if the auditor, one second. Yes. So if the auditor knows before accepting the engagement that threats to objectivity cannot be reduced to an acceptable level, the engagement must not be accepted. So if independence is a basic requirement, it cannot be maintained, the audit should not go ahead. Now about management integrity. Lack of integrity may indicate aggressive accounting, weak controls, intimidation of auditors, illegal activities, aggressive tax behavior, and unreliable representations. So, if management cannot be trusted, the risk of misstatement becomes very high because the auditor relies heavily on information provided by management. Now, let's look at money laundering and client due diligence. The firm must perform client due diligence, and if there is any suspicion of money laundering, the engagement must not be accepted. So, legal compliance is critical here. This is not optional. Now, about resources. The firm must ensure it has high enough time and appropriate resources to perform the audit properly. If the firm is understaffed or under time pressure, the audit quality may be affected. Risk. Any risks such as poor performance, weak controls, or unusual transactions should be carefully considered because higher risks increase the chance of issuing an incorrect audit. Now, finally, about fees. The firm should ensure that the fees is appropriate for the level of risk involved. So higher risk should generally mean higher fees. The firm should also consider the client's ability to pay, as unpaid fees may create a self-interest threat. Because if fees are not paid, the auditor may become biased just to recover them. So overall, before accepting an engagement, the firm must evaluate independence, management integrity, legal risk, resources, and fees to ensure the audit can be performed ethically and effectively. Uh, an engagement should only be accepted if the firm has the necessary skill and experience to perform the work competently. So the firm must be technically capable, otherwise audit quality will be compromised. Now let's look at the client reputation. The firm should consider whether the client's reputation could damage its own reputation. So even if the work is possible, association with a questionable client, can harm the firm's credibility. If the firm believes and may be able to issue an appropriate audit report, the engagement should not be accepted. So, if there's any doubt about delivering a proper opinion, the firm should avoid the engagement altogether. Now, let's look at preconditions for an audit. ISA 210 states that before accepting or continuing an engagement, the auditor must ensure that preconditions for an audit are present and there is a clear understanding with management. So, both the auditor and management must agree on their roles and responsibilities. The preconditions include uh, management responsibility for preparing financial statements, maintaining internal controls, and providing the auditor with all necessary information. So, management must fully support the audit process. If management limits the scope of the audit in a way that will likely lead to a disclaimer of opinion, the auditor should not accept the engagement unless required by law. So if the auditor cannot perform the work properly, the engagement should be rejected. Finally, continuance. After completing the audit, the firm must reassess whether it is appropriate to continue with the client in the future. So acceptance is not a one time decision, it is reviewed every year. If issues such as disagreements with management or concerns about integrity arise, the firm may consider resigning. So ongoing relationships must also meet ethical and professional standards. Okay. Now let's look at engagement letters. Just a disclaimer: preparing an engagement letter will not be asked in your double A exam, but you just need to remember the content of the engagement letter that can be tested. So, the engagement letter defines the contract between the audit firm and the client and is sent before the audit begins. So, this is a formal document that sets the foundation of the audit relationship. Its purpose is to minimize misunderstandings, confirm acceptance of the engagement, and clearly set out the terms and conditions. So, both the auditor and the client know exactly what is expected. Now, let's look at the changes to the engagement letter. The engagement letter should be reviewed every year to ensure it is up to date and but does not need changes to be reissued unless there are changes. So, it is checked regularly but not always rewritten. ISO 210 requires the auditor to consider whether the client should be reminded of the existing terms, especially in recurring audits. So, even if nothing changes, communication is still important. Some firms may choose to send a new letter every year to emphasize its importance. So, this depends on the firm's policy. The auditor should issue a new engagement letter if the scope or context of the engagement changes or if there is a need to remind the client of the terms. So any significant changes require an updated agreement. Reasons for changes include new legislation, changes in professional standards, or changes in senior management. So basically, any factor that affects the adult relationship or responsibilities. Okay, so we are nearing the end. Now let's look at the contents of the engagement letter. The auditor agrees the terms of the audit engagement with management or those charged with governance. So both parties must clearly agree before the audit begins. The terms are documented in a written engagement letter. So everything is formally recorded. Now the engagement letter includes some key elements. Uh, it includes the objectivity and scope of the financial statements, the responsibilities of the auditor, the responsibilities of the management, the applicable financial reporting framework, and the expected form and content of the audit report. So, these are the core elements that define the audit. Now, in addition to this, it also includes reference to professional standards and regulations, the limitations of an audit, and the expectation that management will provide written representations. So, this clarifies the rules and limitations under which the audit is conducted. It also includes how fees, uh, yes, it also includes how fees are calculated and agreements regarding providing information such as draft financial statements and notifying the auditor of subsequent events. So, this ensures smooth coordination during the audit process. It also specifies how the form and timing of communication between the auditor and the client. So, both parties know how and when communication will happen. Now, these are some additional matters that may also be included. This includes involvement of internal auditors, any limitation of the auditor's liability, and obligation to share audit working papers. So these depend on the specific engagement. Finally, the content of the engagement letter must be agreed before any audit begins. So no work should start without this agreement. The client must acknowledge and accept the terms of the engagement letter. So this confirms mutual understanding and agreement. With this, we complete our chapter number 4. I hope you found this video helpful. If you did, please share it with your friends so they can also benefit from it. And if you like it, please like, share, and subscribe to my channel. It helps me a lot. So thank you guys for watching, and I'll see you again in the next video.